Welcome to today's high-level institutional market overview. We are currently observing significant shifts in global liquidity and cross-asset correlations that demand immediate attention from serious market participants. To fully grasp the structural narrative currently unfolding in the precious metals sector and how we are positioning ourselves alongside institutional flow, please watch the full video. Before we dive into the technical mapping, remember that this is an educational video, not investment advice. Our goal is to decode the footprint of smart money to understand where the highest probability of mitigation lies in the current session. We begin our top-down approach by examining the US dollar index, or DXY. Currently, the dollar index is exhibiting clear signs of exhaustion as it struggles to maintain momentum at a critical multi-week resistance level. We observe a failure to print higher highs, suggesting that institutional demand for the greenback is reaching a temporary saturation point. When the DXY is struggling at resistance, it historically provides an inverse boost to precious metals. This lack of dollar strength serves as a primary tailwind for our framework, creating a favorable environment for upside expansion once the local sell-side liquidity is neutralized. Institutional players are closely watching the overhead resistance levels for a potential structural breakdown which would validate our long-term bullish thesis for commodities. Moving to the Volatility Index, or VIX, the fear index is currently printing a rising structure, indicating a significant uptick in market uncertainty and risk aversion among global investors. High fear levels typically trigger institutional safe haven flows into stable assets. As global participants seek protection against equity market instability and shifting macroeconomic data, the capital rotation into gold becomes mathematically probable. The VIX's trajectory suggests that market participants are bracing for volatility, which reinforces the demand zones we have identified on the gold chart. In this environment, smart money tends to accumulate assets that retain value during turbulence, leading to strong defensive bidding and institutional accumulation at these lower price points as volatility spikes. Transitioning to the XAUUSD 1H chart, the market structure remains technically bearish in the immediate term following a clean rejection from the 4,700 to 4,720 supply zone. We have witnessed a series of bearish break of structure events, confirming that institutional selling pressure has been dominant over the last several trading days. However, price has now descended into a major high time frame demand cluster ranging from 4,490 to 4,520. This area represents significant buy-side liquidity where previous aggressive expansion originated. We are currently seeing the market probe this area for a potential floor, looking for signs that the aggressive selling has finally abated and the big banks are ready to reload their long positions for the next leg up into the premium arrays. Regarding our tactical positioning, we are focused on the 4,490 to 4,520 entry zone. We are waiting for mitigation here. Our strategy is not to jump in prematurely or catch a falling knife, but to observe the institutional footprint through volume and candlestick formation. We require a clear change of character on lower timeframes within this demand area to prove that the sell side is exhausted and institutional buyers are stepping back in to defend their positions. Once price action confirms that buyers have successfully absorbed the remaining pressure, we can expect the move to start toward the upside premium zones, with structural conviction and high velocity as the market seeks equilibrium. Risk management remains our utmost priority to ensure long-term capital preservation in these volatile markets. Our invalidation level is strictly set at 4,460. This level is mathematically significant because it sits entirely below the current institutional demand cluster and the previous swing low. If price breaks this level with a sustained candle close, our bullish bias changes immediately, and the structural narrative would shift toward a deeper correction toward the 4,350 liquidity pool. Respecting this level is non-negotiable for our framework, as it signals a total failure of the demand zone to hold the existing selling pressure, which would require a complete re-evaluation of the trend. Should the demand zone hold and the mitigation process complete successfully, we have defined three primary liquidity targets. Scenario 1, or T1, is set at 4,600. This is our primary objective, where initial profit-taking is expected. Scenario 2, or T2, is located at 4,650, which is a mid-range objective. Finally, Scenario 3, or T3, is set at 4,700. This is our ultimate objective, targeting the external liquidity resting above the recent swing high. In summary, since the DXY is struggling and the VIX is signaling high fear, we anticipate this institutional demand zone for gold will provide the necessary foundation for a reversal. Follow for more the next analysis.